Welcome to the Scholar Advising Podcast. Today we're tackling questions about financial decisions that can shape your long-term financial picture. We'll start with evaluating ROI in a vacation rental that's finally turning a profit. Then we'll look at what to evaluate before relocating to a no income tax state. Why taxes may not be the only factor to consider there, or why taxes today may not be the only factor to consider there. We'll also dive into deferred compensation, how to think about the trade-offs of those and whether or not it fits your goals. And in this week's special segment, Money in the Headlines, I'll share my take on recent news story about recession fears. So let's jump in. The first question we have this week is, we own a vacation rental on the beach in South Carolina that's finally turning a profit. How should we account for taxes, upkeep, and long-term ROI? So a couple of things to keep in mind here when we're thinking about return on investment, or ROI. In real estate, typically return on investment gets shifted around a little bit to what's known as a cap rate, which is net operating income divided by the price. So especially cap rates at 5% up to 10%. Generally, the higher the cap rate, the riskier the investment, much like the higher the return on investment, the riskier the investment there is as well. The NOI calculation is what you would think of as pretty much a profit function of what your revenue is or what your rents are for the year, subtract out maintenance costs, subtract out utility costs, any taxes, and then whatever you're left with is your net operating income. Now that can be a little misleading because, especially in a vacation rental, you need to be taking into account whether or not you're renting that every single month, or what the likelihood of you renting it is every single month. So that'd be your occupancy rate. But historical calculations are relatively easy for NOI in that way, because then you don't have to estimate what the occupancy was. You know what the occupancy was. So rack up all the revenue you created for the year, subtract out all your expenses, whatever you're left with is your net operating income. And you can divide that by the price of the house, the value of the house. Is that even better? And I'll explain why. And that would give you a cap rate. And that's how you'd be able to track that over time. The reason I say you should track the value of the house as opposed to the cost of the house is because the cost of the house is fixed, but the value could be going up. So what we commonly see is you buy an investment property, and let's say for ease, NOI is $100,000 and your value is $1 million on it. So you're making 10%, and you keep making $100,000 a year. So you assume that you're making consistent profits. But then what happens when that beach house goes from $1 million to 1.5 to $2 million? Now you're stuck in the situation where you're still earning a net operating income of $100,000, but the value of the house is $2 million. So your profits, or your, in your case, ROI, or your cap rate, has now gone down from 10% to 7.5% to now 5%. So you're not earning as much, even though you earn the same cash flow. Your value being invested, that $2 million, could be sent somewhere else and be earning a higher amount. Now, one other benefit that kind of sweetens the pot here for you is going to be the depreciation treatments. So if you have a lot of income on the passive side that you're able to use the depreciation on, if you haven't already taken this, I guess it depends on how long it's taken for you to turn a profit on the property, but assuming you're still depreciating that asset, you're able to offset some of your income, which has some tax savings. So that has some benefits there that you could throw in as a custom cap rate or a custom return on investment if you want to think about it from your personal side of what are other benefits you're getting. Other benefits too, personal use of it, amount you're saving on vacation. There's a lot of different ways you can customize this. The cap rate scenario is going to be the industry standard. NOI is going to be an industry standard. But for you on the vacation rental, assuming that maybe you get to go take some time down there at the beach as well on the property, then those are also values that you'd want to have in there, at least in some way, to account for it. Now, when you account for how to handle the upkeep and taxes, these are lumpy expenses. Right? Taxes aren't being paid monthly unless you got a mortgage on it and you're escrowing those. So you want to start having essentially a sinking fund for those. In other words, every month when the money hits the checking account and you have some extra money left over, we don't want to spend that immediately. We'd roll that over to a savings account that has enough in there so that way when taxes are due, you're able to pay taxes at the time. It's essentially setting up your own escrow account for that property that you would do for a traditional mortgage. Now, the upkeep is a little bit different. If you're wanting to run this, which it sounds like it is, more like a business than a true investment, then you should run it that way, in the sense of come up with a schedule of when maintenance is going to be due. If you know you're going to have to replace the HVAC units in 5 years, find out what the price is going to be and come up with a schedule of when major maintenance is going to happen, and then account for it, especially at the beach. Maintenance typically is higher as things tend to deteriorate faster. So 1 to 2% of the value of the property every year in maintenance cost is what I would account for on a rolling basis. And then add in there those big lump sum expenses of HVAC repairs, windows, roof, all of that getting mixed in. You have a deck or a dock, those tend to go out faster as well. So by keeping all that in there, then you know how much you're saving every month. And you can put that into a savings account saying this is for maintenance in the future to make sure you remain solvent through all those times. Because what we don't want to do is we don't want you to have all this great cash flow coming from the vacation rental. And then 2 years down the road, you need a new roof and you don't have the cash flow coming in to pay for it. So now you got to go dip into your personal savings to reinvest back into it. That's what we want to try to avoid. And there's some other things you could take into account to make the depreciation even better. If this was a full-time job of yours, managing multiple rentals as opposed to just this one, you could be considered a real estate professional, and there's benefits there as well, being able to offset active income as opposed to passive income. But assuming from what it sounds like, vacation rental on the beach, it's passive income that you're dealing with, I would stick to the basics, good record keeping, a good savings account being built up for that property. And then if you go buy another one down the road, it would be the same process. And you run these vacation rentals just like individual businesses that you own in a portfolio. The next question we have up is, we're considering relocating to a no income tax state. What should we evaluate beyond just taxes? So this was a loaded question because it depends on what state you're moving to. There's a handful of no income tax states, and they're very, very different for many reasons. The biggest one that I see overlooked is the estate tax on all of these, because no one thinks about estate tax. And going to somewhere like Texas, right, where you have no state income tax, you also have no estate tax, is what most people think of when they think of a no income tax state. But compare that to going to somewhere like Washington. Washington is a disaster when it comes to estate tax. You're not going to pay any state income tax, but any amount over $3 million that you have in your estate, they're going to rack up estate tax on you, say it's somewhere around 10%. And then if you go over 9 million, they're going to charge 35% on the estate. But it's a massive amount that you would end up paying from an estate tax perspective, which gets sketchy real fast. So even though you may be saving on the annual income tax, you have to be careful of these other factors as well. Property taxes are a big one. Right? I spent some time in New Hampshire, no state income tax, no sales tax. It was fantastic, right? The live free or die estate, except for property taxes, were some of the highest in the state. And because that's what funded a lot of the schools and everything that weren't receiving funding from the state. And so there's little nuances like that that are deeper in the footnotes, so to speak, of we're a no income tax state. When you really dig into it, higher cost of living comes up as well. Right? Florida is a perfect example these days, right? No income tax, but to try and buy a house in Florida, home prices are through the roof. You can get a lot more for your money somewhere else. And so those are big factors: the estate tax, property tax, or these other hidden taxes. Sales tax too comes up, especially if you have a lot of consumption, right? You're consuming a lot more, or you expect some big expenses to come up in the future. Those can be more of a problem. Maintenance costs, home ownership costs are all big factors. The other one, which is not necessarily in the tax and money aspect, but more from the personal aspect, is where do you want to be? And it's really common that I'm talking to somebody who's trying to evaluate where they're going to live just on the financial implications. And that is not the way to go. That happens really fast, that you move to a different state or even a different country. We've seen that as well. Somebody moves for tax benefits to a different country and then finds out, I don't want to be here. And this isn't what I want. It's not close to family. It's not close to friends. It has none of the activities that I like to do. And that is going to outweigh any of the financial benefits from a tax perspective that you have. So keep those in mind as you're evaluating those no income tax states. Now, that is not to say that I don't like the no income tax states. They're fantastic. You just got to make sure you're choosing the right ones and weighing all of these options, because there are some high income tax states that we want to try to avoid at all costs. And the third one, I've been offered deferred compensation from my employer post-promotion. Should I max this out and wait to pull it in retirement? So the deferred comp conversation, it sounds really good when you first have it. And it's not necessarily it's bad, but there's a lot of nuances to how we want to approach this, depending on how far away you are from retirement. So if you're looking at this and you're saying you just got the deferred comp option and you're 5 years away from retirement, So the risk to you is much less. And to get into those risks, the things you have to watch out for, one is how much they're going to allow you to defer, because sometimes it's not really worth it. But if you're able to defer a significant amount, that could be beneficial, especially if you're in a high tax bracket now, which I imagine you are if you're being offered a deferred comp plan. The other factor, and this is a grand risk for all deferred comp plans, you don't own that money. Right? So if you're 25 years old and you start putting into a deferred comp plan, there's a long time before you're going to take that money, and you have to rely on that business still existing 40 years out into the future for you to be able to use it. If not, it's not your money. You deferred that cash for later. So that's a big risk there. We see this happen a lot with smaller companies or kind of younger employees, that we want to be really careful of how much we're funding that deferred comp, because it's not just how much you fund, but how much it will grow to in the future, because it's going to be invested. So if you go throw $500,000 before 30 and it continues to grow decades and decades into the future, now you end up in a situation where you have millions and millions of your dollars of net worth locked in an account that you're going to have to withdraw in retirement. You say, well, that sounds fantastic, having millions of dollars in retirement, until the company goes bankrupt, or if it's not there decades out in the future, or they get bought out, and you have all these different scenarios. That started to make me a little nervous about you having a lot of money in that deferred comp plan. Now, getting close to retirement, it's a little easier to take that risk, because the odds of a company going bankrupt in 5 years is a lot lower than it going bankrupt in 30 years. Now, the other consideration, and this is one that catches a lot of people off guard, is everyone worries about the contribution factor of how much they're putting into it and how much it's going to be locked up, and they know the risks of possible bankruptcy. But the bigger factor from a cash flow decision is a lot of these deferred comp plans, especially if you're dealing with a for-profit company. These deferred comp plans have restrictions on how soon you have to take the money out of that deferred comp plan once you retire. So we've seen somewhere to say you have to pull all of the money from your deferred comp plan within the first year of retirement, or within the first 3 years of retirement. Now, that's not bad if you just deferred. Let's say you defer $100,000 in your last couple of years before retirement, and you have to pull $100,000 your first year of retirement. It's not a big deal because you're in a low tax bracket. But imagine the situation I just talked about, where you have millions of dollars now that's racked up in this deferred comp plan. You retire, and now you're about to take $1 million income, all paid as income tax. So while you thought you were saving on some deferred taxes before, now you're stuck with this massive, sometimes $400,000+ tax bill on this $1 million that defeated the entire purpose of you deferring compensation. And unfortunately, we've even seen those rules change, not only between companies, but within companies, of what their deferred comp payout looks like. So that's a huge one, because we don't want to have this collision of you retiring and having a situation where you have now a ton of income coming in all in 1 year, and you not expecting it or not planning for it. In that case, I would have much rather you put that into a brokerage account, invested it, and been more strategic about withdrawals in retirement, and stayed at a low 15% tax rate on your capital gains, as opposed to now having to pay income tax on this large amount. So it's not to say that the deferred comp's not a bad idea, but honestly, a lot of what we're talking about today is a lot of nuance around how it would affect you. But those are the considerations that I would be taking into account when it comes to these deferred comp plans, or even 457 plan. Really making sure there's confidence in the company, you're not too far away, or if you are far away, that you're not funding it to an amount that's going to create this massive percentage of your wealth tied up in somebody else's account. And then that last one of just watching that payout timeline, because I've seen that happen way too many times. Somebody has done what they thought was right of in high tax rate years, putting money in a deferred comp plan to pull out in retirement, only to find out that's going to be hundreds of thousands of dollars of income that they're going to have to pull on a timeline that's not their own. And I want to make sure that if you're ever pulling money from an account, as much optionality as possible is best. So we want to make sure you have control of when money's coming out, and not somebody dictating when money's coming out of an account. And now we get into this week's special segment, Money in the Headlines. So in this case, the recent survey highlighted New York Post reported that 77% of Americans have changed their financial habits due to growing economic uncertainty. Many are cutting back on spending, focusing on budgeting, and trying to boost savings, signs that recession fears are shaping behavior across income levels. So this is completely normal. This is what we expect after a bull run in the markets, right? Markets do fantastic. We have some irrational exuberance. Everyone's excited about things, buying prices up. And then reality sets in that the party is probably not going to last forever. And everyone goes back to the fundamentals of finance, right? They pull out the budgets. They start looking at pricing when they're going out to dinner. They start rethinking travel that they're doing, right? You start seeing a lot more interest in gold. You start seeing bonds come back in favor. CDs start to look sexy again, right? It's all these different things start to factor, and it repeats itself. It's just part of the cycle. So this doesn't surprise me whatsoever that that's what we're seeing. We saw some volatility in the spring here, which also follows time periods where you have a lot of certainty, because when the tides are going up, right, and everything is going up, no one's worried about it. That's why fraud always shows up after a bubble. And you have everybody's doing great. No one really cares. Everyone's getting raises. Everyone's employed. So everything continues to move. So you spend without having to worry about it. It's whenever volatility starts to hit and things start to become real that you remember that maybe I should watch my finances a little bit, and maybe budgeting does matter, and what would happen if, and you start thinking of some of these worst case scenarios. And I think a healthy dose of that is pretty good sometimes, especially after market runs. Looking at a survey like that doesn't surprise me, and is probably a good thing and a healthy part of the market cycle. So see a little bit of a pullback to remind everyone that money is not free in the market and that there's risk associated with returns. And there's a risk there. And actually, it's really interesting that we're seeing this now, and that you had a long stretch there from the financial crisis to COVID where you had the longest bull market in history. And the downside of that, because it lasted for so long, it's really easy for people to think that money is made automatically in the market, that it doesn't come without risk. You just throw money in and it makes more money. And you start to have a lot of these, especially with social media, a lot of influencers and everything come out where it's really easy to give financial advice when things are going up, because all advice that you give works out really well. I'd say you want to see some rocky times to be able to show and remind everyone that reward doesn't come without risk, and those always go hand in hand. All right, and it doesn't mean that returns are negative over time or zero over time. We still expect to see positive returns over time, but I like seeing some volatility sometimes, as opposed to seeing a market that's just everyone's winning and everyone's going to go up all the time. That worries me a lot more than anything else. So I'll take that as a positive headline for the week. And that is it. That is our show for this week. I'll see you next time. Hey, this is Stephan. Thanks for tuning in to the Scholar Advising Podcast. If you have a question you'd like us to tackle in a future episode, just send us an email at podcast@scholarfinancialadvising.com. We'd love to hear from you. Until next time.
Scholar Advising is an independent, fee-only financial advisory firm focused on providing hourly financial advice. The information provided in this podcast is for general informational and educational purposes only, and is not intended to constitute financial, investment, or other professional advice. The opinions expressed are those of the hosts and guests and do not necessarily reflect the views of any affiliated organizations. Investing in financial markets involves risk, including the potential loss of principal. Past performance is not indicative of future results. Before making any investment decisions, you should consult with a qualified financial advisor who can assess your financial situation, objectives, and risk tolerance. Thanks for listening.